In this video, I'm going to be breaking down ICT's favorite trading model. If you don't know me, my name is Jeffrey Rodriguez or JRod Forex, and I was part of ICT's original 2016 mentorship group. Now I'm a six-figure funded trader, and I've been trading ICT concepts ever since. I'm going to be simplifying ICT's favorite trading model into three simple steps. Number one, market maker models. Number two, second stage of manipulation or distribution. And the third is going to be the entry model, which is typically a turtle soup into a fair value gap. So enough talking, let's go ahead and dive straight into the charts. So right here, you can see I have three steps for ICT's favorite setup. Number one, market maker models. Number two, second stage of manipulation or distribution. And number three, which will be your entry model. Ideally, you want to be looking for a turtle soup or fair value gap entry. It is even more ideal if you have SMT with it. And number three, the entry model, which is typically going to be a turtle soup with a fair value gap overlapping. And this is really the most ideal entry model for this setup. Keep in mind, it is even better if you do have SMT. So let's break down the market maker models. So number one is a market maker model is basically occurring throughout the charts all day, every day on every single time frame. And you can see here that we have this original consolidation. So basically the market is consolidating at this point in time, and then the market leaves that consolidation with speed, which is when it distributes, and then it comes back into some form of inefficiency. So this would be in the form of a SIBI, sell side imbalance, buy side inefficiency, and the market then distributes lower, trading back into another sell side imbalance, buy side inefficiency, distributes lower, consolidates. So we're going to break this down step by step. So the market maker model basically consists of both the sell side of the curve and the buy side of the curve. Now, the cool thing with this is you can simply invert it and basically it changes, right? So on this side, I know the text is off, but you have the buy side of the curve here now, sell side of the curve here. So this is a very, very simple model, and you want to force yourself to be able to understand and identify these in the actual market because it's occurring on all time frames every single day, multiple times a day. So what we're looking at here is you have your original consolidation. When the market distributes lower and breaks out of that consolidation, this is typically called your low risk sell entry. So ICT's talked about this before. Now, we're not going to talk about taking this entry because in my opinion, you do have a higher likelihood of profitability if you're aiming for that second stage of distribution or that second stage of accumulation on the buy side of the curve. So basically what that breaks down to is right here. Yes, the market has given you displacement out of the consolidation, but you don't know for sure, is the market going to use this to continue lower, or does the market want to trade through it, invert it, and then go for buy side here? So at the point in time that you're looking at the low risk sell, you don't necessarily know what the market's going to do yet. So I always like to let this unfold first, then you look for that second stage of distribution, which would be here, which again, now we have a breakout of the initial consolidation, trades into a sell side imbalance here, distributes lower again. So now we have a higher likelihood that the market is going to use this to send it lower. Keep in mind when you're looking at market maker buy and sell models, you want to be looking for the market to trade into some sort of higher time frame PD array. Say for example, we have a 4-hour bullish order block right here at the level 20,592 on NASDAQ. You can see when the market reaches that level, it starts to pause and consolidate, and then it sweeps the liquidity. So the market runs below these relative equal lows, and then we immediately reprice higher. This is a key component of the actual entry model. So I just want to recap. We have the sell side of the curve. The market consolidated, distributed, came into a sell side imbalance, traded lower, came back into another sell side imbalance. Second stage of distribution is here. Then we sell off into that higher time frame key level, which is in the form of a 4-hour bullish order block in this example. The market pauses, consolidates there. We leave relative equal lows. The market sweeps that liquidity, and then we immediately reprice higher. So this move right here is considered a market structure shift. The moment that the price trades above these previous highs, because we're in a bearish market, we're forming lower highs, lower lows, lower highs, lower lows, lower highs, lower lows. But then the market pauses, consolidates, we make one final lower low, and we immediately reprice higher, taking out the buy side here. So this is a change in the state of delivery. You might have heard ICT talk about this before, but a change in the state of delivery as well as a market structure shift is basically the same thing. So what you're looking for is the market to reprice from a higher time frame PD array or key level. And then when that happens, you're looking for a fair value gap. And then if in this example, if you're on the buy side of the curve, this is going to be a buy side imbalance, sell side inefficiency. Now, one of the key things with these inefficiencies or fair value gaps is you want price to remain above or right at the 50% level on the buy side of the curve. And then on the sell side of the curve, you want price to remain below the 50% level or right at the 50% level. So on TradingView, what you can do if you don't have this setting turned on, for the rectangles, you can come to Style and then select Middle Line. And what that's going to do is basically make that 50% level either show or hide. So this is a key thing that I like to use when I'm trading. Once we see that market structure shift, we're waiting for price to come back into that inefficiency. When price comes into the inefficiency and then respects it to go higher, notice what it's doing. It's coming, it's taking out the buy side liquidity here, right? So that's this push up. We've now taken that liquidity. So what we can do is we can basically anticipate a move higher into the overall buy side liquidity here, which is the original consolidation. Now, the ultimate entry model is going to be on that second stage of distribution. So technically speaking, this would be your low risk buy. Let's say, for example, you have your fair value gap that it also trades into here. This would be your first stage of accumulation on the buy side of the curve. And then you have this fair value gap here, which would be your second stage of accumulation before clearing out the original consolidation buy side liquidity. One of the key things that you guys want to look for, and you can see this in step 3, is the entry model is ideal if it's a turtle soup with a fair value gap entry, even better with SMT. So basically what we're looking at here on this second stage of accumulation, as you can see, the market trades lower, taking out this sell side liquidity, which is in the form of these relative equal lows. And I can move this line, but you can see the market trades lower into this inefficiency. Now, at the same point in time, let's say we're looking at ES in comparison to MNQ while looking at this chart. If ES fails to run below the low, let's say it makes a higher low like that, well, that's a crack in correlation. So you can almost guarantee that this run lower to clear the sell side liquidity is simply just gathering stops before taking it higher above the original consolidation. So when you're looking at these patterns in the market, you want to start training your eye to be able to identify each step of the market maker model. Where is the original consolidation? Where is the low risk sell? Where is the first stage and the second stage of distribution? And ultimately, where is the market going? What is that higher time frame PD array that we're going to trade into? And when we get there, does price respect it and trade away from it? So in this scenario, we trade from an original consolidation where we left relative equal highs, which is going to be in the form of buy side liquidity. The market trades all the way down into a 4-hour bullish order block, pauses, consolidates, sweeps the liquidity, market structure shift into a fair value gap for accumulation, trades higher, clearing the buy side of the liquidity from the sell side of the curve, because everyone that's selling here is going to be keeping their stop losses above here, and then the ultimate target on stops is going to be this buy side liquidity pool in the form of the original consolidation. So these are all key things that you want to be looking for whenever you're actually engaging with the markets, and then try to formulate where am I likely to get in and what is the highest probability setup. In most cases, and ICT said it himself, the second stage of distribution in a market maker sell model or the second stage of accumulation in a market maker buy model is always going to be the most probable entry. And I think the reason for that is simply because generally speaking, we have the most speed away from those levels. So you can see the market moves away from the first stage of accumulation, and we do move away from the low risk buy, which is here. But the biggest move is ultimately here, which is that second stage of accumulation. And keep in mind, when we get that run away from this into the buy side liquidity, it's going to happen fast. It's not going to be something that's just going to chop around. So you can almost anticipate these consolidations. You're not getting sucked in while the market is consolidating. You're waiting for the run on stops. Then you engage price at the inefficiency underneath the sell side liquidity of the relative equal lows into the buy side liquidity here, which would be the original consolidation. So let's go ahead and take a look at a few examples. Right here, we're taking a look at MNQ, and the one that I want to break down is going to be here. It comes in on September 9th, 2024. So basically what we're looking at is the market has been selling off. Now we're in the form of a consolidation, and we want to identify where is the original consolidation. Where did we run away from, right? So we have this here. This is an original consolidation. The market trades lower, comes back into a small little fair value gap here, trades lower, run on stops, and then a massive sell-off. So you want to be able to identify when this happens and it runs above this high. Look at how quick the market moves away. That's a good sign. Now, at some point in the future, could be the same day, could be the next day, could be weeks from now, the market is going to likely reprice to this high and ultimately be targeting the original consolidation here. So let me go ahead and draw a line here. We'll just use this high as an example. We're expecting the market to get back up into 19,375 and 3/4. So how can we engage with price? Where could we find an entry? So the market stops here. We run higher, trade a little bit lower, clearing out some sell side liquidity, run higher. Now we're starting to form bullish price action, right? Higher lows, higher highs, higher lows, higher highs. And we do have a small little inefficiency here. So what we could look at is how does price react from this inefficiency? Now, this isn't the perfect example. It's not always going to look identical to this, but you have to start training your mind on how to actually forecast and see these things as they're actually happening real time. So I wouldn't have engaged price anywhere here until we had this first inefficiency. Now this forms at 1 p.m. and then it trades back into it at 9 p.m. So this is probably something that I wouldn't take based on my personal trading rules, since I'm primarily engaging in New York AM session, generally around 10 to 11 a.m. Eastern Standard Time. But you can see in this example that this continues to happen time after time. We trade into the inefficiency. Notice the bodies of the candles are respecting the inefficiency. We never close below it, which is validating that it is using it to send price higher. Now look at this. The market closes below it. Now look at what we've done here. We have relative equal lows. The market sweeps the liquidity. There is no fair value gap that it's traded into, but watch what happens on the next candle. We can take this as an entry, even though it's no specific fair value gap, because we are now using a reclaimed fair value gap here, and we've come away from sell side liquidity that we've swept. The market immediately opens, quickly retests this reclaimed fair value gap, and is likely going to expand higher for the buy side liquidity of the original consolidation. So this is an hourly time frame. Obviously, we can dive into lower time frames like a 5 or 15 minute, where you're going to see things a lot clearer. So for example, we trade lower, we sweep the liquidity, we start to trade higher, we trade into a small little inefficiency here. This would be your low risk buy. Market reprices. We have another inefficiency here. That would be your first stage of accumulation. And then we have another inefficiency here that gets traded into. You can also use this as a first stage of accumulation as well. And notice how the market continues to trade higher. We're using these fair value gaps to predict where price is likely to give an entry. So let's go back out to our hourly time frame. You can see price looks a lot different when we go into an hourly or even in a 5-minute time frame. We can see a lot more clarity in terms of what's going on with price. So when we identify these things in the market, we want to drop into the lower time frames. For example, if we're on an hourly, we want to drop into a 15-minute, or for me, my personal favorite for an entry is going to be the 5-minute time frame. There is a plethora of entries that you can use to get on board with this. Let's keep in mind we're targeting 19,379. So we've still got significant amount of room away from that. This is an entry, this is an entry, and there's multiple entries throughout this price run, but what we're really looking to capitalize on is that second stage of reaccumulation, since we are in a market maker buy model. So you can see here, once price leaves the liquidity, after we've swept it, we start getting big expansive moves higher. You can use any of these fair value gaps to get on board, but my recommendation is going to be identify that point in which you're in that second stage of accumulation to find out where the most probable entry is for you to get a quick, snappy move into that original consolidation. So some of you might take this entry here and then close out here. Some of you might take this entry here and hold it the entirety of the move up here. But what you're looking for is, again, time and price to overlap with one another. So if we look at time, this is going to be the start of the PM session at 1:30. And where could we get on board with this? Well, let's zoom in, and you can see that we have a small little fair value gap right here. And this is a perfect entry. We trade into the fair value gap. The wick stops perfectly at the bottom of the fair value gap. Body closes above. You can enter inside of the fair value gap. You can enter as soon as it closes above it. You could really enter anywhere inside of this range, and you're targeting a run above 19,379. So if your model is trading the PM session, you can simply take it on this fair value gap, hold it into the buy side liquidity, and that's 120 handles. So you don't have to worry about any of these missed moves down here, like the low risk buy, first stage of accumulation, second stage of accumulation even, because sometimes the second stage of accumulation will happen and you don't necessarily know or are reading that it is the second stage of accumulation unless you're in tune with where the market is likely to go. So I always use fair value gaps. Like I mentioned here in the steps, it's better if we do have an SMT or some form of turtle soup into a fair value gap. But in this example, all we have is a fair value gap. We don't have a turtle soup, but we can still use this to engage price into that original consolidation, which is at 19,379, and that would be our target. Now, as you gain more and more experience, you can take this low risk buy. Stop loss below here, target up here. That's a 3.7R setup. As it gradually trades higher, you could see this becomes a 37.51R setup, and your stop would have never got hit if you're trailing it properly. Now you could also use this fair value gap, the one that we see here, and you could have your stop below the low risk buy. As price trades higher, you can begin to move your stop below this low and then trail it in profit. As you do that, you increase the R multiple on the overall trade. But for me, I don't necessarily have to get in down here. I'm waiting for the market to tip its hand and confirm to me that it is going to run that original consolidation. I don't necessarily know if it's going to run the original consolidation when we're here. So then it uses another bullish fair value gap, trades higher, takes the buy side liquidity here, small little fair value gap that never gets traded into, so I can't use that one as an entry. So then I have to wait. Trades higher, higher, higher. Market goes into PM session right here at 1:30. New fair value gap is formed. Boom, that's my entry. As soon as this candle closes and we trade into it here, I'm buying it. Stop loss below the most recent low, target in the high. As price trades into that original consolidation, I'm taking the full profit off. Now, it's a different story if I'm taking the trade and pyramiding in along the way. But for those newer traders out there, you just want to focus on that second stage of accumulation or distribution into the original consolidation target. Now, let's go ahead and take a look at another example here. We do have these relative equal highs. The market trades all the way down, fails to take out the low here, and then notice what happens. The market begins to trade higher. And then look at what we have here. We have a buy side imbalance, sell side inefficiency. What is price doing? The bodies are staying above the 50% level. This is all good signs for a strong bullish market. So what we could do is, yes, you could take this as an entry, but once the market confirms it, now it comes back down, gives you another opportunity to get on board. We trade higher. We just trade slightly above this high with the wicks, and then notice what happens. We consolidate, we consolidate, we consolidate, consolidate, and then boom, we get an expansion right through it with big, large up range candles. This is what we're looking for. Now, you may not be able to anticipate this move specifically, but entering here on the fair value gap after you have the market structure shift above this high, because the market was bearish forming a high, a low, lower high, lower low, lower high, fails to make a lower low, but when the price closes above this high, that is an immediate sign that we have a market structure shift. Watch the fair value gap. If it uses it to trade higher, that indicates that you're in a bullish market and you're looking for a run above this buy side liquidity. The market wicks it. Let's say you enter here, that's your target. But let's say you believe it's going to run through this with speed. As the market is consolidating, you can start going into the lower time frames, and then you can find an entry inside of this consolidation that will take you above the original consolidation. For this example, I'm going to go into a 15-second chart. I don't recommend that you guys do this for newer traders out there, but I do just want to show you what this overall example will look like. So we can see here that we have the original consolidation high. Now, I want you guys to see what happens after we sweep the liquidity. Can you see this? Relative equal lows, takes them out into an inefficiency, and then we run higher. This is like the golden setup right here. Sweep on liquidity, turtle soup into a fair value gap, respecting 50%, trades higher. Even just from here to here is a trade. But let's say you missed that one. All you have to do is wait for price to trade into the other fair value gap right here. Now, you might be thinking, well, the bodies of the candle don't stop at 50%. But you have to keep in mind that we've already ran sell side liquidity here. So if you're using this fair value gap and you missed the first one, your stop loss can be very small and be underneath here because this low has already ran the liquidity. So if we put our buy order here at the top of this fair value gap, stop loss would go below this low and our target would be, this high. Now this is only a 0.72R setup, nothing crazy, but we are on a 15-second time frame. If we held this through the actual original consolidation, you can see how the R multiple increases. So again, there are so many setups like this that are actually happening throughout the chart. You just have to start to train your eye to be able to see these things, and it's happening over and over and over again. Market trades lower, fails to make a lower low, leaves equal lows, trades higher into an inefficiency, higher high, all the way back down, up, down, boom, expands through it. There's your market structure shift into the inefficiency. Notice how it trades into it here, rallies a little bit, only to come into a bearish inefficiency, then back down, sweep in liquidity. Now we get the expansion move. There is market maker models inside of market maker models. So this may be a little confusing, but we're in a higher time frame market maker model. But this right here is also a market maker model. This is the original high, sweep on liquidity here at a key level, boom, we expand through it. So you can use this in so many different variations, but you have to start training your eye to be able to see them. Ideally, what you're looking for is you want to get on board price when we're in that second stage of accumulation or that second stage of distribution, ideally taking you into a key level and or taking you into the original consolidation like we see here. So after breaking down these examples, hopefully you guys found a lot of value in terms of how to utilize this in your own personal trading. That is going to be it for today's video. Again, if you guys found value in it, go ahead and leave a thumbs up and subscribe to the channel as it helps the channel out a ton. Also, drop me a comment below. Let me know what's your favorite to trade. Do you prefer trading market maker buy models or market maker sell models? For me personally, I tend to like selling more than I do buying, so I prefer market maker sell models. But either way, work flawlessly, and I highly recommend that you guys use them. So with that being said, I'll see you guys in the next video. Feel stuck in your trading or you're unprofitable or break even, go ahead and click the link down below in my description for a simplified trading framework that you can start applying to your trading today.